Hello, and welcome to the Money Goose podcast. Thank you for joining us both today. In this episode, we will talking through how you can identify what kind of investor you are by assessing your risk tolerance, investment horizon, and financial goals. So, before we get into the nitty gritty, let's step back. Why does figuring out what kind of investor you are even matter in the first place? Isn't investing just about picking stuff that goes up?
I get that urge, but the truth is, knowing your investor type shapes almost every decision you make. It's not just about chasing gains, it's about making choices you can actually live with, even when the market goes haywire. For example, if you need your money in 5 years, you'd pick totally different investments than someone with a 30-year timeline.
So it's a bit like knowing whether you're planning a road trip or just running errands in town, your route and what you pack totally change.
Exactly. And if you pack wrong for your journey, you could end up stuck or stressed out. That's why this whole process isn't just financial, it's also emotional.
That brings us to risk tolerance. Everyone talks about it, but honestly, what does it actually mean in practice?
In simple terms, it's how much stomach you have for seeing your investments bounce around. Would a 30% drop keep you up at night, or are you unfazed? Some people can shrug off wild swings, others get shaky after a 10% dip and start thinking about selling.
And it's not just hypothetical. 2008 saw the S&P 500 drop 37%. People who stuck it out eventually recovered, but you had to be okay watching big losses for years.
Exactly. So your risk tolerance isn't just about what you hope you can handle, it's about what you've proven you can stick with, especially when things get scary.
Let's make it concrete. If someone's not sure about their risk tolerance, is there a quick test they can do?
Absolutely. Imagine your portfolio drops 25% in 1 year. What's your gut reaction? Would you buy more, hold tight, or sell? If you'd panic sell, you're probably on the conservative side. If you'd hold or buy more, you're leaning aggressive.
It's funny how thinking in real dollar amounts like could I watch $20,000 become $15,000 makes it feel way more real than a percentage.
It really does. And that's why advisors will often give you a scenario or have you score your reaction, just to get beyond wishful thinking.
So, besides gut feelings, what else actually influences someone's risk tolerance?
A bunch of things: your income, savings, family obligations, even your past experiences. If you have a stable job and a year's worth of emergency savings, you can ride out more market bumps. But if you're freelancing with uneven pay or have a big bill coming up, you shouldn't risk as much.
And I guess age and goals come into play too. A 5-year-old saving for retirement can afford more swings than someone buying a house in 2 years.
Right. And even seasoned investors sometimes get a reality check when they live through a real market drop. That emotional muscle only builds with experience.
Let's talk about the 5 main investor profiles. What should people know about these categories?
These profiles run from conservative to aggressive, mostly based on how much stock versus bonds you're comfortable holding. For example, a conservative investor might have 20% in stocks, 80% in bonds, great if you're near retirement or can't stand volatility.
And on the other end, aggressive investors might be 90% or even 100% stocks, lots of ups and downs, but you're chasing big growth over decades.
Exactly, and most people land somewhere in between. Balance is that classic 60-40 split, which aims for steady long-term growth with manageable risk.
So time horizon seems to come up everywhere. Why is it such a big deal in picking investments?
Because if you need your money soon, you can't afford a big dip right before you pull it out. That's why short-term goals like buying a house in 3 years should be kept in cash or short-term bonds. But if your goal's far off, say retirement in 30 years, you can ride out the storms for higher returns.
It's like not wanting to be caught in a storm if you have to be outside soon, but if you can stay inside for a while, you might weather it.
Precisely. The longer you have, the more you can let compounding do the heavy lifting.
Let's break down how different investments fit along the risk spectrum. If someone's conservative, what's on the menu?
For low risk, you've got cash, CDs, short-term treasury bills. These keep your money safe, but returns are tiny. If you want a bit more, high-quality bonds give steady income with moderate risk.
And for folks who want growth and are okay with bumps, that means more stocks, right?
Yep, equities bring more upside and more roller coaster rides. There's also real estate or even riskier stuff like crypto, but those come with their own baggage. The trick is matching your mix to what you can actually handle, not just what looks good on paper.
Have you seen cases where someone's investments didn't fit their actual needs and it went wrong?
Plenty of times. Imagine a retiree with 70% in stocks. If the market crashes right when they start withdrawing, their portfolio can drop fast, and they may never recover. Panic selling after losses actually locks in the damage.
And on the flip side, being too conservative means missing out on long-term growth, so you might outlive your savings.
Exactly. That's why you need to check both the short-term risks and the long-term opportunity cost before you set your allocation.
Let's say someone's ready to put this into action. Where do they start with designing their actual investment plan?
First, map your goals to a timeline. For short-term needs, like a big purchase, in 3 years, choose safety and liquidity. For retirement 20 or 30 years out, lean into equities for growth. Next, set your risk tolerance and pick an allocation, like 60-40, 80-20, or whatever fits your profile.
And having a plan for rebalancing, selling high, buying low keeps you from drifting too far from your comfort zone.
Exactly. Putting your rules in writing makes it way easier to stick to your plan when things get rocky.
This makes me wonder, how do strategies shift for short-term versus long-term goals?
For short term, it's all about keeping your balance safe. High yield savings, CDs, or short term bonds are your friends. Returns stay modest, but you avoid nasty surprises.
But if your horizon is decades, you really want to let stocks work for you, even though that means big swings sometimes.
Absolutely. Over 30 years, stocks have historically bounced back from every crash. The key is resisting the urge to bail out when things look bleak.
Something I hear over and over is diversify, diversify. Why is that such a big deal for investors?
Because even if one piece of your portfolio takes a hit, the others help soften the blow. It's like not putting all your eggs in one basket, but with a twist. You want baskets in different places. A 60-40 mix of stocks and bonds has weathered storms better than all stocks, helping people stay calm and avoid panic selling.
And you can diversify across geographies, sectors, even different asset types like adding some real estate or international funds.
Exactly. Just watch out for overlapping funds or hidden fees. True diversification gives you the best odds of sticking to your plan, especially in wild markets.
For people who want a little help, what tools or tests can actually help pin down their investor profile?
There are some great online quizzes, brokerages, and robo-advisors have free ones that ask about your age, goals, how you'd react to losses, and so on. Then there are risk simulators, which can show you how your chosen mix might perform in good years and bad.
But those quizzes aren't perfect, right? Sometimes people say they'll hold on, but real life is different when the market tanks.
Definitely. That's why you shouldn't just trust the quiz. Run your results through a scenario, like a 30% drop, and see how you actually feel about that outcome.
Let's talk about getting help from a pro. When does it make sense to hire a financial advisor?
If your situation is complex, lots of assets, tax questions, or nerves, during downturns, a fee-only advisor can be worth it. They do more than just pick investments. They help with tax loss harvesting, withdrawal plans, and keeping you from panic selling.
But there are different fee structures, right? How do you know what you're paying for?
Great point. Some charge by the hour, some by assets under management. Always ask for a clear breakdown, check for conflicts of interest, and make sure they're a fiduciary. That means they have to put your interests first.
What are some of the biggest mistakes you see people make when it comes to their investor type?
The classic one is stretching beyond your comfort zone. People pile into stocks thinking they'll stay calm, but when a big drop hits, they panic and sell at the worst time. Another is never updating your plan as life changes. Marriage, kids, job changes, all these can totally shift your tolerance and needs.
So the key is to turn those gut feelings into specific numbers and to check in regularly, not just once.
Exactly, run a risk questionnaire every year, and after big life events, move your allocation gradually if retirement's getting closer, and always have clear, written rules for when to rebalance or adjust risk.
For someone just starting out versus someone nearing retirement, how should their portfolios differ?
A new investor with decades ahead might start with 70 to 80% stocks and the rest in bonds, using low-cost index funds and auto contributions. Someone close to retirement should tilt toward more bonds, maybe 40 to 60%, and set up bond ladders or annuities to cover a few years' expenses.
And if you're shooting for early retirement, like the FIRE crowd, you're probably cranking up the savings rate, holding more cash, and planning a conservative withdrawal rate.
Absolutely, plus running scenarios for bad years and holding enough cash to weather downturns without selling stocks at a loss. The point is to make sure your plan is realistic for your life, not just theoretical.
So, if someone's listened through all this and is ready to act, what's the best next step?
It starts with being honest. How much risk can you really tolerate, and how long can you leave your money alone? Then pick a simple, diversified allocation, maybe with a couple broad index funds, and automate your contributions. Write down your rules, check in each year, and don't be afraid to adjust as your life changes.
And if you're not sure, start small, get a feel for your emotions when markets move, and don't rush big changes. Building a plan you can actually stick with beats chasing the latest hot tip any day.
Couldn't agree more. The goal isn't perfection, it's creating a strategy that lets you sleep at night and stick to your goals, no matter what the markets throw at you.